Friends, welcome to another episode of Finance and Investing Tidbits. In this video, I'm going to talk about how holding and investment companies are different from mutual funds. As I have elaborated in a few other videos on holding and investment companies, holding and investment companies actually provide a wonderful opportunities for retail investors, particularly those investors who don't have time to really track too many companies in great detail. Holding and investment companies provide a wonderful alternative. In addition, the prices of these holding and investment companies at which they are traded in the stock market quite often are significantly lower than NAV. On the date of this creation of video, I can tell you that I hold a particular company which has investment in its group companies. The price is just about 20% of its NAV. This is unbelievable, but that's true. So in this particular video, I'm going to draw a distinction between holding and investment companies on one hand and mutual funds on the other. So there are some benefits and there are some risks also. So I'm going to touch upon both those aspects. Welcome to this video. Typically, holding and investment companies belong to some industrial group or the other. Thus, the exposure of such holding and investment companies is significantly to group companies. There could be many group companies of that same group in which this holding and investment company may have invested. They also invest in other companies, but to much less extent. Mutual funds are collective investment schemes which pool savings of various investors and in turn invest in equity and or debt instruments as per the mandate of the scheme. And naturally, mutual funds are far more diversified as compared to the investment and holding companies. So in this video, let's explore the differences between holding and investment companies on one hand and mutual funds on the other. Holding and investment companies are legally structured as companies and are often listed on the stock exchanges. So naturally, as retail investors, we are only concerned about the listed holding and investment companies. Mutual funds are formed as trusts which hold the assets, and the assets are managed by asset management companies, which by structure are companies again. But our money which has been invested is not held by those asset management companies, but by the trust. Income of these holding and investment companies are taxed in their hands. Of course, now the corporate tax rate has come down. There is also a significant change in the dividend taxation, which has worked to the benefit of these holding and investment companies. But nonetheless, there are tax implications. On the other hand, mutual funds are not subject to any income tax, and therefore, whether it is the capital gains or whether it is the dividend, they are to that extent more tax effective as compared to holding and investment companies. In case of investment and holding companies, risk is more concentrated to a few stocks. Naturally, because most of that portfolio belongs or is invested in companies which belong to that group. Whereas in case of mutual funds, risk is quite well diversified. Shares of investment and holding companies trade at a significant discount to NAV, like I mentioned at in the intro part of this video. Currently, I hold such a company which is trading at 80% discount to the NAV. Now, there have been times when this company was trading at 65% discount to NAV. Now, clearly, when the discount which has become 80% shrinks to 65%, there is a massive upside which becomes available for retail investors, even if the NAV remains the same. If NAV goes up, then obviously there is an upside to that extent. Units of mutual funds have to be bought or sold at their NAV in case of open-ended funds. In case of close-ended funds, of course, they are all traded like a share, and therefore while they are expected to be as close to NAV as possible, there could be slight divergences between the price and the NAV. Shares of holding and investment companies, if listed, can be bought or sold through an exchange. Of course, there are unlisted holding and investment companies, but we are, as retail investors, concerned about holding and investment companies which are listed, and naturally they can be bought or sold easily through an exchange. Open-ended mutual funds, on the other hand, can be bought or sold with the mutual fund directly. Close-ended funds, if listed on the exchange, can be bought or sold there, like shares. Number of shares of investment and holding companies are constant, unless of course there is a bonus issue or split. Then that's a different story. So it works very similar to any other company. In case of open-ended funds, the number of units keeps on increasing or decreasing. In case of close-ended funds, the number of units remain constant, but they can change hands among existing investors and new investors. Very similar to shares. For more such videos, do explore our channel, Dr. Abhijit Fitness.